My people, what's happening? All right, so I got a special request from a young man on YouTube. Asked me to talk about how to purchase a home. It's something that I discussed in a couple videos, I think, but I'm going to kind of put it all together on this one, specifically for purchasing a home. I'm going to talk about two different things. All right, number one, to purchase a home, the only thing that they care about is your tax return and bank statements. Okay. On top of bank statements, they may want like a check stub or W-2s or something like that. All this stuff can be manufactured. Okay. The tax returns, however, those items they will actually request from the IRS. So you have to make sure that you actually file a tax return with the IRS. Okay. So I'll say that again. To qualify for a mortgage loan, you typically need bank statements, check stubs, tax returns, or W-2s. Okay. Now, all of those items can be manufactured. It means you can just create them. Okay. But the tax return, that actually has to be filed with the IRS because they will request that tax return from the IRS in order to qualify you for the mortgage loan. So, if you want to qualify for, let's say, a $300,000 house, then you may want to have, $120,000, $150,000 on your tax return. Very easy to do. Okay. Now, what you'll need to do is you'll simply need to file a tax return with $150,000 on it. Okay. Now, I've gone through this more than a few times, and typically they want their income to be either self-employment or some sort of wage income, right? If it's income from a rental, they don't really want to consider that. If it's income from a partnership or from a corporation, that's okay. But typically, like I said, self-employment or wage income is what they're looking for. All right, so you simply file a tax return with, let's say, $150,000 on it. Okay, you file that with the IRS. Now, when you file it with the IRS, you're also going to file a payment arrangement. All right, that payment arrangement, depending on how much income it is, if it's $150,000, maybe the payment arrangement comes out to $400 a month. Okay. And you're going to pay that $400 a month until you qualify for the house. All right. Once you qualify for the house, you move in and everything. Then you're ready to amend the tax return. Okay. To take away the $150,000 of income. And then you'll get a refund for the $400 a month that you paid while you're waiting to get approved. This is something that happens quite a bit. I'll have people that, want to file a tax return, but they don't want to pay taxes, which means they're lowering their income, their taxable income. But when you do that, it makes it look like you don't make a lot of money, right? And that's a problem for for purposes of qualifying for a house. So what I've been doing for the past 5-6 years, and what I recommend everyone do, is actually file a return every 3 years. And what I mean by that is that in 2018, okay, I'm going to file a tax return without any deductions, no expenses. All income. Okay. Now, I've already paid cash into the IRS throughout the year, but I'm still going to have a small balance due. Okay. Not a big deal. While I file my 2018 tax return, I'm going to amend my 2015 tax return. On my 2015 tax return, I'm going to put in all my expenses, all my deductions. Right. And so the refund from the 2015 tax return will more than cover the amount due I have for 2018, and I'll actually get a little bit of a refund back. Okay. Now this is coming from someone that don't have any kids, nothing, right? So, having that little refund is nice. And then I'll do the same thing. So next year I'll file a 2019 tax return, all income, and I will amend my 2016 tax return. All right. And I do that every 3 years. So if I go in for a loan, whether it's a business loan, whether it's a personal loan, whether it's a mortgage loan, whatever loan it is, when I go in and apply for that, they're going to ask me for my last 2 years of tax returns. And my last 2 years of tax returns are going to have nothing but a bunch of income. So I qualify easily for whatever it is I want to do. Okay. Now, that's number one. Okay. Number two, when you talk about how to purchase a home, now, I'm going to talk about a couple things, actually, not just one other thing. If you have a church, okay, if you have a church, then a portion of your housing is tax free, it's tax deductible. All right. And so what that means is let's say you buy a house, you move into the house, and you create a church, and the house is now part of your patronage. Okay. And let's say that the fair market value for rent on that house is just say $1,000 a month. Okay. You'll be able to deduct a portion of that $1,000 a month as your ministerial wages, and that'll be, you know, tax deductible on your personal tax return, because, you know, you won't have to pay that. Now, of course, that's easier to do when you are self-employed. If you're a W-2 employee, then that only works if you contribute, you know, more than $12,000 or $24,000 or $18,000 to the church every year before it even becomes worth it. Okay, so another thing is, if you're going to purchase a home, I don't suggest doing this with a personal home that you plan on living in, but if you plan on purchasing a home to maybe rent out, or even if you're planning on purchasing a home to live in and rent out a portion of it, then what you want to do is you want to use a 401k in order to do so. The reason why is because the 401k, when you put money into it, okay, is tax deductible. So what that means is, if I put $1,000 into an IRA right now today, I'm going to deduct $1,000 from my tax return. So that's $1,000 tax deduction. That's simple, okay? I'm going to take that money out of the 401k, out of the IRA, and I'm going to use it to purchase a home. Now, how do you do that? Well, you have to have a trust, right? And I'm saying trust, but it's not really a trust. It's someone that you trust to create a C corporation. Okay, the person that creates the C corporation, you're then going to purchase shares of that C corporation. Now, the 401k, the IRA can own 100% of the shares of that C corporation. So in effect, the 401k or the IRA now owns that corporation that is actually created by someone else. Okay, I'm going to say that again to make sure everything is understood and clear. But someone that you trust is going to create a C corporation. Okay, it's in their name, but you can purchase 100% of the shares of that corporation, so that your 401k, your IRA now owns it, which means you own it. All right. Now, you take the money out of the IRA, you purchase the shares of the corporation. You use that money to buy a house. So now, any money that house makes, if it's a rental property, any money that rental property makes, okay, the profit rather is going to come back to the IRA tax free, because IRAs are non-taxable. Okay, you don't get taxed on the money until you take the money out of the IRA. All right. Now, you can take the money out of the IRA, you'll be taxed on it. But what you can do is, the corporation can own a car, right? Now, sorry, my battery is getting low. Anyway, so the corporation can own a car. The corporation can pay food. The corporation can pay for travel. Corporation can pay for supplies. Corporation can pay for anything and everything. The only thing the corporation can do is pay you, because they do. Then that means that money is now taxable. Okay. Corporation can own a boat. Corporation can own other homes. The corporation can own anything it wants, and you can use those things for your personal use, sort of. Right? The only thing, like I said, is you can't take cash out. Once you take the cash out, you have to pay tax on it, and it's only just, you know, income tax, and then there's a 10% penalty unless the money is used for education or medical expenses. So that's the best way to go about purchasing a rental property, because, like I said, that money will be non-taxable. From me to you, now holla.